What are the leading M&A advisory investment banks saying about the deal-making outlook? Is private equity getting more active on the M&A front? How can these investment banks help their clients in a higher for longer interest rate environment? Find out all of that and more on the next episode of the Pipeline Podcast. Hi, and welcome to this episode of The Pipeline, an S&P Global Market Intelligence podcast where we talk about all things M&A and IPOs. I'm Joe Mantone, your host, and with this edition, I'm going to review some of the forward-looking commentary about the M&A environment that executives from Lazard, Moelis, and Evercore gave on their recent earnings conference calls. I like to review these calls to get a sense of the outlook for M&A because M&A is such a big part of their business for these investment banks, and much of their earnings calls is spent discussing future activity. The first quarter of this year did bring a bright spot in terms of large deal announcements. During the period, there were 10 transactions that had a total value that surpassed $10 billion. This was the most since the second quarter of 2022 when 11 such deals were announced. This is according to market intelligence data. But the total number of deals for the first quarter was at the lowest point since the second quarter of 2020. That was the period when the whole world stopped during the global pandemic. Higher interest rates have been the biggest factor in the lower level of activity. The higher rates lead to higher financing costs, which can limit what buyers are able to pay in an M&A deal. And the lower bid price creates a disconnect between buyers and sellers. More simply put, sellers don't want to sell at lower prices, and buyers can't afford to pay up. However, on the Lazard call, CEO Peter Orszag did offer some comments that noted that some of the headwinds tied to higher interest rates are starting to abate.
Meanwhile, headwinds have generally diminished in force over the past few quarters. During the first quarter, market expectations became more closely aligned to the higher for longer rate environment, reducing a source of mispricing risk in the market. In addition, the difficulty of finding financing when rates were rising had largely abated.
Executives at Evercore and Moelis also said improved financing conditions had helped boost the pipeline of their transactions. Their backlogs are more robust and stronger now than they had been. But the executives did note that challenges still remain in the M&A market. One of the challenges is getting private equity firms off the sidelines and transacting more. A key driver to the M&A boom that we saw in the back half of 2020 and throughout 2021 was the participation of private equity firms in the M&A market. However, those firms have been slower to transact ever since the Federal Reserve started the rate hiking cycle. And even though rates have been steady, we haven't really seen that big of a pickup from PE firms. Moelis CEO Ken Moelis said his company's business was still weighted more toward public company deals and strategic deals as opposed to PE deals during the first quarter. He said PE firms were not that active in the beginning of the year because at the time the market was anticipating 6 rate cuts, and part of the skill of private equity firms is to try to time the market and transact at the most optimal time. So if the market is anticipating 6 cuts, PE firms aren't going to transact until after the Fed starts cutting rates.
You might get ready for market, but you're not going to go till 1, 2, 3 of those cuts happen. I think you're trying to time that market.
Ken Moelis can get animated on his company's earnings calls, and to underscore his point about PE firms not wanting to sell assets before the Fed is expected to cut rates 6 times, he described what it would have been like for a more junior employee at a PE firm to suggest an exit of a portfolio company earlier this year.
Imagine going to your investment committee and say, let's go to market. And some senior guy at the firm looks at you and says, what kind of idiot are you? The Fed's going to cut rates by 200 points in the next 6 months. Why wouldn't we go then? And you go squirming back to your seat and never talk to the guy again.
But Moelis wasn't saying that rate cuts are needed in order for PE activity to pick up. he was saying now that the market is expecting much fewer cuts this year, that the transacting is closer to occurring.
I believe at this point, as like I said, if somebody guaranteed there will be 0 rate cuts for 2 years, I guarantee you that. I believe the market would explode with transactions because people would say, now I know that if I wait to May, there'll be no difference. There is capital out there. There is actually acquisition capital, single B, even triple C paper right now has come in dramatically to finance these types of transactions. And I think we just have to take away the opportunity that if I kick off my sale in June, it'll be a different rate environment. If that happens, by the way, great. I do think that would be a good thing. It wouldn't be a bad thing. But I don't think the market is waiting for a rate. I don't think this market needs a rate cut to accelerate pretty dramatically from here in the private side. And the public side is already executing, and they're pretty aggressive. I believe the public market is executing, and the only thing holding that back might be FTC issues for large transactions that don't want to go into this regulatory environment.
Evercore CEO John Weinberg believes private equity firms are going to start feeling pressure from their investors, the limited partners in the funds, to start selling assets and return some capital to those investors.
I think the sponsor community is becoming more set on moving forward than has been in the past. And I think part of it is that there's just an intensity level that they need to get back to business. I think that there is clearly going to be a higher for longer that people are looking at. But I think that there's a lot of dynamic in and around the sponsor population that really is going to play into how the deals go forward. And I think our observation would be that the activity levels are very high and there is a real intention to start making things happen. One very important factor is the LP community, which really is very much of the view that they would like to see transactions happen and get some capital returned, frankly, so they can put capital back to work. It's been a long time since they've really had really healthy returns, and they really need that. GPs are thinking about how they raise funds. And I think generally there is a view that it's important to start really showing activity. As you know, there's about $3.8 trillion of dry capital ready to go. And I think that really the sponsors are feeling like they need to move. Our experience with the sponsors is that there's a level of intensity and intention that we haven't seen for quite some time. So our view is that it's going to pick up. Clearly, rates will have some impact. I certainly don't want to paint the picture that's not important, but I think that there are some other factors at play here that are going to make sponsors push much harder.
Lazar has already seen a difference from private equity firms.
We're now in the stage of the cycle where sponsors are coming back on the playing field.
Orzag also took some time on the call to talk about how private equity can help with the firm's restructuring business. Typically, when we hear restructuring and private equity, the natural assumption would be that private equity firms are looking for distressed assets, buying companies on the cheap. In this higher for longer environment, some of that will undoubtedly occur because companies who need to refinance their debt at higher rates might not be able to afford the cost. But investment banks would prefer to find solutions that help right the ship and avoid company from selling from weakness or going into Chapter 11. One way Lazard is looking to do that is finding private credit solutions for companies that are facing debt maturities. Private equity firms have been raising funds and putting more resources towards private credit. And Orzag said finding private credit options is one way Lazard provides, quote, liability management services. He said much of his company's current restructuring business is liability management right now.
Quarter restructuring liability management was over 2 times what it was in the first quarter of last year. Do you expect that an elevated level of activity will continue? as the debt maturities that are approaching interact with the higher for longer environment. And we feel like we are now very well positioned with a more diversified team covering creditors and debtors, and that has much more connectivity to private capital, where a lot of the activity is occurring to continue to be active. Frankly, even as interest rates come down, this will continue to be, as the maturity walls, it will continue to be a significant area of activity.
I think an interesting read through on this comment is that the rise of private credit funds gives advisory focused investment banks an ability to get greater exposure to the debt business. Typically, it was only the more full service investment banks, such as bulge bracket firms and other firms that use their balance sheet to underwrite debt. Typically, those were the only investment banks that benefited from providing financing. Advisory focused firms were not in that business because they have a different model. They don't want to use their balance sheet to underwrite debt. They just want to provide advice to clients. Now, with the rise in private credit funds, they can help advise corporate clients on whether they should turn to a private credit fund to replace their existing debt. If the advisory focused firms can leverage their financial sponsor contacts, they will have a real opportunity to get greater exposure to this debt business. Moelis recently added a managing director to enhance its coverage of credit funds. And during his company's earnings call, Ken Moelis talked about how capital markets transactions can sometimes be similar to M&A assignments.
If the idea of putting $1 billion into some position in a capital structure, it usually involves what we consider our clients, the PE firms or the private credit firms, which is a very one-off, bespoke conversation. It often entails things like negotiation of governance and exit rights and all kinds of things that are just not conducive to a plain vanilla distribution. And oftentimes also discretion and secrecy, and people like a lot of people that might involve conflict of interest with your senior lender. And that causes people to not want to have their senior lender involved in that. So this is all like, and the fact that it's available is fantastic for our business because, yes, we were having those conversations a year ago, but the capital wasn't that available. It was very hard. You might have had a perfect position to put a capital, but the capital didn't want to move yet. They were very worried about 7% federal funds rates, and there were all kinds of issues around how bad this was going to get. The fact that capital is now in motion and looking for those opportunities means I think our hit rate on marrying up a problem with a solution will be a lot higher.
Evercore's John Weinberg also talked about the potential for liability management through his company's restructuring business.
Our view on restructuring has been consistent, which is it's a very strong business for us, and it's continuing that way. And higher for longer, obviously, will impact the business in a positive way. But even when we thought that rates were going to go down, a very big part of our business is liability management. There are many companies that really have capital structures built on very low interest rate environment, and some of those are coming up for refinancing. And so the liability management side of the business is going to continue strong. And really, from the prospects that we see in our backlog, continuing along at the pace where we feel very comfortable that they're going to continue to perform at a high level. As we look at our projections and we're looking at how things are going, we believe the business will continue along the path of being quite strong.
Improved restructuring and liability management revenue would certainly help the advisory-focused investment banks get through these lean M&A times. How much it helps remains to be seen. But that'll do it for this episode of the Pipeline Podcast, so thank you for listening.